Let's talk about airdrops. If you've been in the crypto space for more than a few months, chances are you've either received one or chased one. Airdrops are one of the most hyped events in crypto. They're free money, right? A reward for early adoption, a thank you from the project to the community. But behind the excitement, airdrops come with a hidden cost, and that cost is often paid in the form of distorted incentives, spammy behavior, short-term dumping, and in some cases, full-on market manipulation. In this episode, we're going to explore what's really going on behind the scenes of major airdrops. How did this mechanism, usually meant to reward loyal users, become a magnet for wash trading, Sybil attacks, and extraction strategies that hurt the long-term health of a project? So let's start with what an airdrop is supposed to be. In theory, an airdrop is a way to distribute a token to users who have interacted with a protocol or supported the project in some meaningful way. It's meant to decentralize ownership, reward early adopters, and give users a reason to stick around. But in practice, airdrops have actually become something else entirely. Over the last few years, we've seen the rise of airdrop farming. That's when users create dozens or even hundreds of wallets to interact with the protocol in a way that appears organic, but is really just farming eligibility. Take the example of Sybil attacks. These are coordinated efforts to spoof real user activity by duplicating behavior across multiple wallets. The goal is simple: claim as much of the airdrop as possible while doing the bare minimum to qualify. The end result, a handful of actors controlling a huge chunk of the distribution. Then there's wash trading. On NFT marketplaces and DEXs, airdrop eligibility is often based on volume or number of trades. This creates a huge incentive to game the system. Users trade with themselves or collude in small groups to inflate their stats. The protocol thinks it's seeing explosive growth, but it's all artificial. We saw this with Blur, the NFT marketplace that launched an airdrop tied to trading activity. Blur overtook OpenSea in terms of volume, but much of it was wash trading. Traders were flipping the same assets back and forth to farm points, with no real intention of holding the NFTs. When the airdrop came, many of these users dumped the token and moved on to the next opportunity. Another example was the Optimism airdrop. While it was considered relatively successful, it still experienced a lot of sell pressure immediately after launch. Despite efforts to target real users, many recipients had no long-term connection to the network. They sold their tokens and disappeared. This raises a big question. If airdrops mostly lead to short-term dumping, are they actually helping projects? From a tokenomics perspective, airdrops inject a large supply of tokens into the market all at once. That creates immediate sell pressure, especially if recipients didn't buy it with their own money. For many, it's just found money to cash out. And from a community perspective, airdrops often attract the wrong kind of user. People who are there for the reward, not the mission. They don't contribute to governance, they don't build, they don't stick around. So like that Talking Heads song, how did we get here? In the early days, airdrops were small, spontaneous events. Projects like Uniswap rewarded early users with Uni tokens. That airdrop created massive goodwill and helped kick off a whole new trend. But as more protocols copied that model, expectations changed. Users began to game every new app, hoping it would do an airdrop. New wallets, bots, spoofed usage, it all became part of the strategy, and it was all fake. Entire guides and forums popped up teaching users how to maximize their chances. And as more data became available about what past airdrops rewarded, the strategies became more refined. Sybil attacks got better at hiding their tracks. Wash traders got more sophisticated. Real users were drowned out by extractive behavior. Now, that doesn't mean airdrops are doomed. It just means they need to evolve. Some newer projects are experimenting with better models. Thank goodness. Instead of rewarding pure volume or transaction count, they're looking at qualitative engagement, things like community participation, educational milestones, or long-term staking. Protocols like StarkNet and ZK Sync are trying to balance these factors in their upcoming airdrops. They've announced criteria that include anti-Sybil filters, engagement metrics, and weighting for long-term activity. But even then, there's no perfect solution. The challenge is that any publicly known airdrop strategy can and will be gamed. And if it's kept private, real users may miss out entirely. So what can you do as an investor? First, be realistic. If you're farming airdrops, understand the trade-offs. Yes, there may be some free rewards, but you're also spending time, gas fees, and taking on smart contract risk. It is not risk-free. Second, watch how a project handles its airdrop. Is the team being thoughtful? Are they actively fighting Sybil abuse? Are they prioritizing long-term users over short-term farmers? Third, be cautious about investing in tokens immediately after an airdrop. The initial price action is almost always volatile. Lots of people sell right away, and it can take weeks or even months for the market to find a stable floor. And finally, as a builder or contributor in crypto, think critically about whether an airdrop is really the best way to build a community. Sometimes giving tokens to your loudest supporters doesn't bring in the people who actually care about your mission. Let me know in the comments, have you ever benefited from an airdrop? Did it make you more loyal to a project, or was it just a quick flip? Have you seen airdrops that actually helped a protocol grow in a meaningful way? And if you want to learn how to identify high signal projects, cut through the noise, and protect yourself from extradive hype cycles, check out learningcrypto.com. We've got detailed breakdowns of token mechanics, incentive models, and how to recognize when you're being played. Thank you so much for watching. I'll see you in the next video.